Hello, very warm welcome to all of you. I'm Shravan Kumar Sreenivasula, Director, Products and Advisory at Avendus Wealth Management. I and my team assist the ultra-HNIs, family offices and treasuries with their investment needs across various asset classes. Avendus Wealth manages close to $4 billion across 1,000 plus families and treasuries. Today, we are privileged to have with us Mr. Manish Singh, who is the CIO of Crossbridge Capital, managing $4 billion across various asset classes as well. He has expertise in managing advisory portfolios covering multi-asset classes, alternate investment, and structured products. For the next 1 hour, me and Manish will be discussing various things, primarily the latest trends in the global investing landscape. Manish, thanks for joining.
My pleasure.
Let's start with the first question, Manish. You're sitting in London, where the lockdowns have been put again. I am in Mumbai, where lockdowns could come in the next week or 10 days. How do you think this COVID thing is going to pan out? Because March was pretty scary for the markets.
Well, that's true. And the good thing is that we do have some vaccines now which are in the pipeline, and that should be a big help. What is without any doubt is that the support from the fiscal and the monetary authorities are just going to continue. So if you take that into account and add to it the good news that we are getting on the vaccine front, then that should come as an encouraging sign. Nobody is talking about deficit and debt target. Everyone is talking about how to spend and how to support the economy and the jobs, and to prevent this from being a deep economic scar. And we just finished the Chancellor's statement in this country about the spending review, and UK economy is set to shrink by 11% this year, which is the steepest shrink in 300 years. So we are really talking about economic contraction on record scale, which can just mean one thing, is that the fiscal spending is just going to continue. If need be, it is going to be raised, and monetary policy is going to continue to be where it is. So if you do not have any headwinds from increased interest rate or any austerity policies, then that is seen as a positive. So that should help the economy, that should help the market.
And how long could you think that this could go on? I think we already got a big fiscal package in the last 6 months. Definitely in the next 6 months, we're going to see more. Do you think that's enough, or are we going to see more of it going forward?
Well, there is no timeline to it, how long they can, because it totally depends on how soon the vaccines are going to be put into use and how soon people can go back to work. So I don't think that anybody has a fixed timeline. Of course, everyone's intention is to get it back going as soon as they can, realistically. In my opinion, I do not think that things will get back to normal at least until April or May. That's my personal belief. Though I do think that the governments are keen, and the willingness on the part of the people also to restart is extremely high.
I think from a monetary policy perspective, we have is the zero bound. There is an expectation of MMT which could come both in the US and across the world. What is your sense you're getting? What will the impact of MMT be?
Well, it's a very controversial policy to be sure. It's a modern monetary theory, or you call the magic money tree, whichever way you wish to define it, if you're critique of it. My view is that MMT is already happening. I mean, it is not going to happen later on. All the spending that you are seeing now, it's all basically money being printed and supported and given to people, whether they are earning it or not. And that's what has happened. But is it the right thing to do in a crisis? Yes. Should this be the norm, even if things were to go back to normal? Absolutely not, because there will be consequences for it. So for now, I think it's justified. Anybody will tell you that you do not tighten the budget or come up with austerity policies when you are midst of a crisis. So MMT is happening. It is happening now. It's not debatable. But should that be the policy and continued policy going forward? That, in my opinion, will be a wrong thing to do, because at some point the bill will come due, and you would hope that this bill would come due in a normal fashion, not in manner of hyperinflation, because that is devastating. But to any central banker, any economist, to any investor, if you ask them to choose between deflation and inflation, they will choose the latter. And in that respect, I think for now it's fine, but one has to be very careful that this doesn't continue once the recovery is in.
I think in the last 1 month or 45 days, we have heard various people say that if Biden wins, markets could correct, the US markets, and then followed by the global markets, and if Trump wins, market could see a renewed trajectory upwards. But I think even with Biden winning, we saw markets going up. I think the first day it was Trump winning, markets went up. The second day Biden winning, markets went up. Is it a reflection of markets discounting a lot of negative news, and there is, for lack of better option, people are just investing money into equities?
Well, I'd say you have to look beyond the headlines. So it's not that the market went up because Biden won. You have to look at what was the result about. The result is that there was no blue wave. The Republicans have won 13 seats in the House. They've taken 13 seats away from the House 13 seats away from the Democrats in the House. They still maintain the Senate. They have not lost a single state legislature. So it was a very strong mandate to continue with a very centrist policy. So if you look at it from the lens of Biden won and the market is rejoicing, that's not true. The market is rejoicing because the crazy left policies that some thought would happen under Biden is just not going to happen. And that's the reason why the market has gone up. The second is that if you look at the appointment we are talking about of Janet Yellen coming to US Treasury, I mean, she said as late as this April that she wouldn't be against central bank buying equities. When you see somebody of her stature who clearly is very well networked and knows the US government and international finance ministers and everything that you can imagine, saying that she's not against central bank buying equities, what does that tell you? That there will be a backstop by way of US Treasury and that's to private assets and equities, and one should feel enthusiastic about buying equities at reasonable prices, not just buying everything, but at least there's that fear factor that you'll be left on your own or central banks are going to act and spoil the party before. That's just not going to happen. So the rejoicing is happening because of the nuances around the victory, not purely because of victory.
Are we in a 1999 kind of scenario or 2003 kind of a scenario?
See, if you refer to the dot-com bubble of 1999, or should we go back and look at 2003 where you are starting off a massive bull market, I think it's a latter one. And well, there are certain sectors in tech, which have been bid up. And if you have, electric car companies being bid up, look at names like Tesla, which has no hydrogen truck, no asset to say, and $13 billion company, then of course, there are stocks, you have to be very careful about, and they may not deliver what they have said. But largely speaking, I think the nature of the economy or the people and what they are going to look for is going to shift permanently. You're not going to go back to pre-COVID days in the way it should be. To give you a simple example, if you look at any shop, they didn't have any plans of selling things online. All these shops now have plans of selling things online. They're just not going to shut this down and then go back to just selling from the shop. That's not going to happen. So there's a lot of change of behavior which is going to stick because people will also think that what if you have another virus coming down the line in 12 months time or 18 months time, how do you prepare for it? Even corporates would have the same thing. They would think about, do we really need this massive office spaces when we can have 30-40% of our people working from home or at least manage? So a lot of change behavior is there to stay. I don't think that everything is going to go back to normal. We'll go back to probably living normal as before COVID days in terms of not wearing a mask. I hope that happens, but not in terms of the economic behavior or the economic change. And that has accelerated, and therefore some of these cloud software tech companies, they will do well, and they should do well because they are delivering those things in how people are going to change their behavior. So I don't think that is a bubble, apart from few stocks and some sectors maybe. And if you look on the other side, why 2003? Because again, we are talking about massive supply of fiscal supply. This has to show up in the economy. There's going to be restocking. Forget about new production, restocking, because if you ask any corporate now, what is their plan over the next 12 months? They've cut their plan massively. They are not producing as much as they would like to produce again. You will have that production coming online. You will have restocking coming online. And the third thing is that you have corporates who actually are delivering sales, but at a massive reduced cost. So they have massive reduced cost. The profitability is high. So the operational leverage is very high in these companies. I'm talking about large cap companies. the big companies are gaining market share in this from smaller companies. Smaller businesses are getting devastated. Big companies are getting market share, and they're going to continue, and this is going to help them a lot going forward. So I do not see central banks are going to come and raise rates immediately. I do not see fiscal thing taken away, because the fear that you could have another round of virus or this could spread will stay for at least next 6 months. And when this money that has been printed eventually makes into economy, and it will, then that will lead to nominal growth, and that means you'll have continued bull run.
I think one more thing which has happened in the last couple of weeks is that on the 9th of November, when this news of vaccine came, there was a sudden shift of money from the structural, the tech stocks kind of a theme to suddenly the ones which are into cyclical and industrials kind of theme. How should one realign the portfolio? Because now vaccine is a reality. There are 3-4 companies which have come and said that there is a high probability of going into production in the next 2-3 months. People would get it. How would one reorient their portfolios? If somebody was playing the structural tech long-term stories and suddenly this back to normalcy trades are coming, would some allocate some money to it or stick with the structural ones?
See, I would say that your allocation should not change drastically, because I wouldn't expect anyone to have their portfolio 80% in tech names just because of COVID, because that will be a silly thing to do. I mean, if people have done that and they have made their money, then they will have to cut those positions and come back to normal allocation once again. But your neutral allocation in terms of having large cap value stock, which a lot of people were not buying before, you should buy that more. And no matter what the tech sector does, no matter what some of these outside returns have been, I think if you orient your portfolio majority of that, you're taking a gamble. It's not investing. I think investing wise, you still have to look at the consumer discretionary, consumer staples, tech and industrial and other sectors that are coming in, and then populate your portfolio using that. I strongly believe in having a large cap bias, because we run portfolios based on moderate risk, not very high risk. There is a component that you can run in the tech stock that we talked about, where things are changing behavior, but that should not be more than 10% of your portfolio. I think you should largely still have large cap stocks which also have done well. I mean, you see some of these big names like Disney, Estee Lauder, they have all come back. I mean, they were down in the dumps at one point, but they've all come back, because that these companies are amassing huge amount of advantages over smaller companies, and they're going to deliver better earnings because the operational leverage has increased, actually, because the funding cost has been low, cost cut has happened, and now all they're looking for is to increase in earnings. And you should be worried about high growth stock, because how do you value stocks? By discounting earnings. So if your expectation of interest rate increase on the long term is going to increase rapidly, which it will as things start opening up, then a discount factor becomes very big, and then suddenly those tech stocks are going to fall or going to sell off. And the opposite happens for us. It's like holding a growth stock is like a long duration position, and then fear of having an interest rate increase decimates such valuation, because you're not going to discount in the same manner. And when you're holding a value cap stock, it's just the opposite. It's a short duration position, so you're very comfortable and you're not valuing any growth. In the first case, you're valuing a lot of growth at a small discount factor. In the second case, you're valuing very less growth and the discount factor is very small, as in both cases when the rates are zero. So I think some of these growth stocks will correct, and they should correct, because that will be the natural theory to play. But as I said, if you're looking at few names like Teladoc or some other names in US, which telemedicine is not going to change. I mean, you are going to go. If you look at stocks like Peloton, I mean, you're not going to go and bicycle in a gym when you can bicycle from home, and you can have data, record, comparison in a group and other things. I mean, these are changing behavior. So there are stocks out there which will do well. But then Teladoc or Peloton, they are going to also suffer when the revaluation happens. But that's a matter of timing. I don't believe you can time the market. If you buy stock for the right reasons and hold a medium term, if you should have a medium term holding outlook, then you shouldn't be concerned about what's happening to one of these stocks in a month if they're down by 10 or 15%.
From a multi-asset position perspective, just shifting gears, and we'll come back to the market questions later, but just from an asset allocation perspective in clients' portfolios, I think, what are the things that you're seeing? Obviously, the interest rates are low, and hence the allocation to fixed income, would require a relook. Like that, are there any other things which clients have to be aware of in terms of changing their asset allocation mix and orientation?
Yeah, I wouldn't say I don't believe in like big wholesale change, in portfolios from once you set what your target returns are. What has happened is that clearly you're not getting returns on the bond side, at least on the US dollar. If you're putting money in developed market and if you're doing anything in euro, then basically you're getting nothing from where things are. Even a 10-year Greek bond gives you 0.8 or 0.9%, which is not compensation enough to what may happen in the eurozone. So a lot of your returns have come from the equity side, and this is where structured product comes into play. Because when you try to sell a put on a large cap basket of 3 or 4 stocks, I mean, you can still generate a coupon of 5 to 6%, which you can't in any other scenario. So you are essentially still trying to generate income, but using a different play. Instead of using the bond, you're using stocks. There's no point buying a 0.9% yield 10-year bond. I would rather keep that money in cash if it is not costing me anything. The other side is that if you look at emerging market sovereign bond, they have been a good play and they have been good investment. If you look at the Chinese government bond or some of Chinese blue chip bond, they have still given you much better yield in dollar than any other assets. Same, I would think, goes for the Indian sovereign bond as well. So where the yields are going to continue to get lower and come more in line with what's happening in the Western world. So it has given you those returns. And some people who didn't make money, or they're looking at yields now on some sovereign bond in Europe or in US going down to sub 1% level, these guys have made the returns in capital gains, because when the yields collapse, they did make 10-12% in a particular year on a bond. Well, that's your return for next 2 or 3 years. So one should not look at this point of time, I'm going to get only 1%. That's because you got 12% over 1 year, which you shouldn't have, because that's how the yield curve moves. So if you take a portfolio approach and look at 2 year out, 18-month out, 3 year out, then you're not going to make any crazy decisions of just going everything into equity or everything into. You shouldn't. I mean, that is not the way you should change. You should look at your returns over a period of time and match it against the targets that you have set. Sometimes you will get all of that return first year. That doesn't mean just you go hammer and tongs and change the allocation for next 3 years because you're getting low return going forward in a particular asset class. So discipline is very important, I would say.
Even though money is made in terms of market, there is a mark-to-market gains. I think there is a tendency for clients to look at the future returns and then change the portfolio. Mm-hmm. Do you see that clients are moving towards emerging market sovereign bonds or equities?
See, I would say that the shift is slow and depends on obviously the risk profile. A lot of money has left emerging market, as you will know, and a lot of them are coming back now based on dollar weakness theory. One structural change which I see is happening is that, and not all emerging markets are same, as you know, because everyone has their own idiosyncrasies. But I feel very strongly about China, Korea, and other markets which have done well or which should continue to do well. And there, I think the yields on sovereign bonds are going to continue to collapse. The PE ratios in those markets are going to go up and come more in line with the US assets, because that's where people are looking at. Because if you do not have growth in US, or at least you have less growth and basically zero growth in Europe, you are going to move to markets where you do have growth.
True.
And which means that those equities will get bid up, those bonds are going to get bid up, yields on those bonds are going to come down, and the valuation re-rating is going to happen on equities. So yes, that change is going to continue. You have seen that the Chinese equity market was one of the best performing market over the last 12 months, 18 months, despite the coronavirus and COVID crisis. And it's for a reason, because there are companies over there who are now a global market player, and they have their own big consumer base to which they are selling, and that just helps their earnings. So the trick always is, how do you invest in these companies? That's the question that one should always look at. Thankfully, there are ETFs coming out now, and there are lots of ETFs on the market which create a basket of investment that you can do. And also there are US lines of listing of some of these companies which you can invest in, And that's where you will see a lot of market risk. But that is still not taking into account a lot of returns that are being made domestically on A shares in the local market, which people would love to access. And I suggest probably one has to access through a fund, because somebody has to do due diligence on these companies as well. But that's a secular story, that the emerging market valuation will go up. The yields are going to continue to fall until they come to a time where they match up what's happening in the Western world. You cannot have one place where yields are 0, another place where yields are 5%. I mean, it cannot exist for long term. So that narrowing has to happen.
Are you seeing more money moving into unlisted space? Recently we've heard about CalPERS, trying to allocate more towards private equity. Your client portfolios or across, money moving to listed space?
I think that's a very difficult thing, in the sense that I don't see from an allocation point of view, at least to me personally, it doesn't make a lot of sense to invest in assets which probably will give you the same amount of returns or less return. I think the private equity and alternative asset is a great selling item, because what happens, unlike a equity book, you don't have to market on mark-to-market basis on daily basis, so you never see. And if somebody tells you the equity market is down 20% and none of the private equity funds are down 20%, then you shouldn't believe them. The point is that you don't value your asset. So when an end investor never sees this volatility, which is captured in valuation, they think they're holding an asset which just doesn't move along with the market, and it is completely uncorrelated. So it's a great line to sell to people. Is it a wrong way to look at it investing? Absolutely not. I mean, if anybody had the luxury of just taking the money and saying, come and see me in 5 years' time, I'm going to give you X amount of return, well, I think you can do as well or even better than what private equity do. But sadly, that's not the way the liquid market works. So it's a different way of looking at it. Should you have an exposure to some of this private equity asset? Absolutely, but for merit, not based on it's a private equity asset or it's an alternative asset, so I should have 15 or 20% in my portfolio. No, you should have, if you can find these assets and a good fund who's going to manage these assets, but not per se, I'm just going to spray and pray and put 20% in this, 20% in this. That doesn't make sense to me. It has never made sense to me. If you're investing, taking risk in the market, there are plenty of liquid assets that you can invest in, which will give you liquidity, which will give you very similar returns, and you may not have to go into PE assets. But there are lots of PE funds who do a very good job, and they should be pursued and invested in.
Can you walk us through, what happened? How did you manage in the month of March, April? Very helpful for the clients, who are investing, as well as the bankers. From a client management perspective, from an expectation management perspective, just walk us through the fall which has happened in the market in the month of March, April. How did you handle the clients, and what is that which one has to remember in such drawdowns?
I would say that especially with private clients, what they really like is clear communication, and especially in these times, when you can tell them that you have to re-stress the point that what are you managing this portfolio for? You're not managing this portfolio for 1 month. You're managing this portfolio for 2 years or 3 years or 5 years. Then look at what assets are you holding in these portfolios. If you do not have an asset which is going to go bankrupt, you already have done a good job. So let's say if you have a stock, any stock, choose a Estée Lauder, let's say it's one of my favorite stock, Costco. You are buying companies which will have earnings because there is a continuous business around it. And the only reason some of these assets are falling because somebody needs liquidity somewhere, and people believe that these stocks are going to fall and they want to book a profit, or there are people who believe they can time the market, they can get out of it and then come back in time. I don't know many people who do that, who really manage to exit and come back in at the right time. Then you start looking at what is the forward-looking way of where things are going on. I remember I sent out an email on 16th of March, saying that 18th of March is going to be the bottom, which is a Friday. The market bottomed on Monday, the following Monday. And my view is that, I can already see that fiscal authorities are going to come in, monetary authorities are going to come in big time because of the movements you're seeing in the treasury market, and that will not be allowed to fall because of the consequences that is going to happen on the other asset classes. So when you start looking at this picture, then you just go and buy with both your hands. I think the mistake that a lot of people make is that they keep looking for that bottom. and then they never find that bottom because it's not an easy thing to do. And then when the market rallies another 10%, they say, well, market is rallied 10%, let's wait. And then it goes to 20. We say, oh, now it's up to 20. Now let's wait. Do not try to time the market. That's the most silly thing to do. And if you're getting it right, or if you think you have got it right, just count it as a luck. It's not a skill. Do not try to do that. Look at if the market has fallen by 20% or your favorite stock has fallen by 20 or 30% and you still believe in that stock and company and management, you go and buy. You do not try to chop and change just because index has fallen by 10. And look what happened. I mean, if you look in terms of stock market, you've had a V-shaped recovery. Within a matter of 2 months, you are back to almost making most of your money. And now we are much higher. And all the forces present, our monetary and fiscal authority forces, are telling you there is going to higher. Could you have another March-like situation? Yes, of course you could have a March-like situation. It goes without saying. But only thing you have to bear in mind, we are talking about nominal asset. Nominal asset grows with inflation and GDP growth. So the best thing for these things, go and look at any stock chart, S&P 500, and most of these corrections will not even register on those charts if you draw the timeline. I always insist in good companies, good management, things that you believe in. You should never sell that, and you should buy more of that. And if you happen to have cash and the market is low, just buy more and just average yourself out and keep investing.
There is one school of thought which says that, look, the cycles are getting shorter and hence, it's always better to book out some profits and wait for the corrections to happen and then re-enter the market. You any word for that?
I don't disagree with that. I think that, if you think that, okay, if you set a target, I have to make 15 or 20% this year, I made that money, I feel that things around me are looking very expensive, then by all means, you can stay in cash and see when it falls. But then when the market falls by 10%, then don't start thinking it's going to fall by 20% or 30%. That's the mistake again people make. So once you've got that 10% gap, you should again go and buy the things you like. Now it may be that it falls by 30 and not by 10 and you went in a bit early, but at least you went in and you registered again when things come back. So yes, if you can time it in the sense that, okay, I have seen that the evaluations look high, I do not see any immediate growth, I see headwind, then if you want to stay out, that's fine. I mean, that's if you can do that, yes, it's a good strategy.
Manish, last decade has been, decade of developed markets, particularly the US in terms of market performance. And prior to that was emerging markets. Do you think that, again, the previous decade performance will reverse for the next decade?
Sorry, you mean to say, is it going to be emerging
markets come back? Yeah.
See, I structurally think that emerging markets should come back just because of growth scenario we are looking at. On one side, you are seeing economies high on debt, i.e. developed market, low on growth. And on the other side, you see economies, which are lower on debt and high on growth. But also, let's not forget that a lot of these things are dependent on local policies. Just by virtue of being low on debt and high on growth, and a lower valuation by itself is not going to drive your equity return, because if that was the case, then you would have made lots of money in Russia. I mean, it trades at a PE of 6. I mean, it has been permanently undervalued market. But what really matters is what your local policies, government policies, and fiscal policies and stability is. And that has always been the big risk factor in emerging market. If you cannot offer stability and continuity of policies, then investors are not going to stay. So you are going to see portfolio inflow, outflow, and the only economies where you are seeing stability and a large stability is China, which is why the Chinese equity market continues to do well, because people start seeing them as a US market, where the market is deep, the regulations are getting stricter. You saw the Chinese government pull the plug on Ant Group IPO. I mean, it was commendable. People are drawing wrong conclusions from that. What China is telling you, that they will not allow their financial institutions to become too big to fail, so they can hold the government to ransom, which is what is happening in the Western world. They are going to put the stability of the economy and system ahead of any innovation, which is the right thing to do, which is the kind of lesson everyone should draw out from what they are doing. So if China continues to develop in those lines and regulates it better, and has learned from the mistakes that have been made in the Western market, then of course, those markets are going to read it. And I keep saying a re-rating of Chinese market is going to happen. You're going to make a lot of money on those markets, and of course it's a communist system, so the risk always stays. Where what happens if the party doesn't do well or something, but that's the risk you have to bear when you're going in a market, and that same risk you do not have on the opposite side, because it's a market system. But how much of a market system it is when you can get the rates to zero and do things that you want to do, and maybe turn around and say, well, your money is not as valuable as it was 2 years or 3 years ago. So you do bear the risk of, basically it's a difference between the system one understands. One is more comfortable dealing with a market system than one is dealing with the command economy that China is. But if you see which one has delivered growth and which one is smarting out, it's the latter. And this is something people have to get their heads around and try to understand based on outcomes. What are outcomes? And outcome-based investing is the best thing. I think that you can cut the noise around. And on that basis, yes, it could be, but not all emerging market. I do see a lot of political instability in emerging market.
Where does India stand in the criteria which you just defined?
See, I would say that, we have done a good job, at least in terms of stability. There's plenty to be done in terms of economic policies, which I think there's a lot to be done. I think that we have done a decent job, not a very good job. If you sit outside and look at how the government communicates and how the finance minister communicates, I don't think that they do a bad job, just that they don't boost the confidence as much of an investor. So it's not about that they have done anything negative. It's just that you are looking for those positives, those sparks, which makes you believe that these policies can continue more and government can do more, and you can trust, and you think that the economy will come out stronger. So largely, I don't think that government has done a lot of negative, but then they haven't done too much positive either in terms of helping the economy. They're trying their best. Ironing out legislation, promoting, being more pro-business, being more. Those things, it still lacks. You just do not get that feel of how fast that India should move, given the growth expectation that one has. And as an investor, it's about opportunity cost. So if I don't put my money in India, I'm going to put somewhere else. And if I see a market where I can get a better return, then I'm saying, okay, let me look at India next year. So it becomes like, let me look at next year.
In the discussions which you have with your companies locally, do you think that there's a China plus one strategy which they are following? And do you think India could be a beneficiary of that?
I think given the size means that India will be a beneficiary. There's absolutely no doubt about that. I think it just comes down to how do we align in terms of our foreign policy? Because I strongly believe that China and US will eventually trade a lot better than they do. The trading relations between them will become much stronger, just because they will realize, or they do realize, that they need each other. And they are the two big nations, G2 nation in the world, who's going to drive everything. And that just makes the Chinese case stronger. So if you line up against China, then obviously it doesn't make you look in a good light. And I have a feeling that sometimes in India we do make this mistake, is that we are wittingly or unwittingly seen that we are lining up with the US against China, which obviously doesn't go down well with China, or we try to take the measures to stop Chinese businesses from doing businesses in India. I think use regulations. If somebody is going to put their capital into your economy and grow your economy, welcome them. They should come and develop the economy, and then use your own rules and laws to see how it is going to benefit the economy and benefit the people. Because ultimately, there is nothing better than economic strength and power. And if you can't do that, then you have to borrow that, whether it is capital, expertise, invite companies, and in due course, build yourself, because that's what China has done. That's what China has done. That's what US has done. That's what, the history of US is of monopolies. Monopolies built America. Monopolies are building China. But these are monopolies who work in a very private interest. They are creating something, not monopoly for the sake of it, where you just employ 200,000 government employee and try to develop something. It doesn't work like that. There has to be a private characteristic to it. But that should be allowed. And in that you go and partner with whoever you have to partner until you achieve that growth.
I think in the last few minutes, you have mentioned multiple times about stimulus and inflation. But looking at the gold price action recently, it looks like it's in a different trajectory, not accepting what is happening across. What is happening in that asset class?
See, I'm not a big fan of gold. I have to say, I've never been. I think that gold is good as a jewelry. I mean, that's how you should see it. It does help you in times of disaster if you lose trust in everything. Is gold your ultimate insurance? Yes, because if nothing is working and if you have a piece of gold, something, it helps you. You're going to transact using that. Am I looking at a situation where we could end up like that? I don't think so. I think that what you will have, losing the faith and war, I mean, that's not the scenario anyone is talking about. So when vaccine comes, clearly people move in the opposite camp. They say, well, you don't need gold, which is why gold is falling, because you think we are going back to the normal way. But that in itself should not be seen as gold is not performing, because remember, what's the job of an insurance? That when you need it, you call it and it pays a premium. Thankfully, we don't need that. So that's what you do. When you buy a life insurance, you don't want the insurance to be called on you, right? Because you don't want to get the capital out of it. So that's your ultimate insurance that you pay for. So just see it as a cost, as an insurance cost, which will protect you in a rainy day. The rainy day has not arrived, and therefore your insurance premium is being used. But that's how I see it. And if something happens, you make money, otherwise, well, if you never call that insurance, means everything else went well for you. Your equities went higher, you made your money on bond, and that should be your payoff. Don't look at getting a payoff from gold.
That's very well put. That's very well. Do you track cryptocurrencies? I think the action there has been stupendous, and our clients inclined towards cryptos?
Not our clients. We don't do anything on that front. I personally know what's happening and a lot of things that are happening over there. And I think it's a function of the amount of liquidity that is sloshing in the economy, amount of money that people have made. That asset class especially has got a lot of boost over last 1 month, when other investors have come out and said that they would allocate money to such assets. I do think that those assets are going to continue to rise. That market is going to get bigger. It's in a market where you can make big money, you can lose big money, absolutely certain. You saw what happened to Ether, down all the way up to $800, down to $100. You could lose 80-90% of your money. So long as you're willing to take that risk, then one can invest. But I do see that market evolving and that market developing and becoming bigger.
An investor is underinvested. Do you say that this is a good time to enter?
I would say every time is good time. As I've said before, I just do not believe in timing the market. Just look for assets, which have fallen more if you want to build your portfolio alongside that. But from what I see, I just do not see any risk of where this big correction things are going to come from. You've already had an economic recession. We are start of a new cycle. In this cycle, looking at S&P, it's up 50% or something, or 60% from the bottoms. Cycles can continue much longer. Cycles come to an end because central banks raise rates. That's the important thing to understand. A lot of time recession is driven by central banks because they do not want things to go out of hand. And I just think that if you have nominal growth coming from increased demand, pent-up demand, and everything that's going around it, and the money flows to people, so long as it leads to increase in productivity, i.e. more people getting the wealth, and that increasing the consumer power, and therefore leading to more growth, you could have a growth cycle that which would continue. I mean, I don't believe in looking 5 year out. I look only 12 month out. When I'm looking at any investment on 12-month basis, I do not see any risk.
Where do you stand in the debate of passive versus active?
Yeah, I would say that there is a role for both. The markets where you do not have the capacity to do research, do not have the capacity to take individual risk, the ETFs help you. So like if you want to do China domestic, unless you have a team who wants to do research, you're better off buying the CHIS or CHIQ ETF, which gives you a basket of exposure. The market that you do understand, in the US tech market or large cap stocks or European finance or something, I think you're much better off doing single stock risk. So it's basically it's horses for courses based on what your personal bandwidth is. I always say that look at yourself, look at how well you can do something. Just don't do something because someone else is doing it, because what someone else is doing is good for them. If that person is a good active investor, he or she should invest in stocks. If you're not, then you should be investing in ETF baskets, and look at ETF basket. If you're working at a firm where you don't have 100 analysts, you cannot do active investing. So you have to rely on a combination of the two. The mistake is everyone tries to copy someone else without looking at the position they are in or how they want to work with that, and live by that. And I think if you look at ETFs, I think there are only very few ETFs that have outperformed the S&P over the last 5 years. And I would say 5 or 6 of them have been tech ETF. Choose XLK or some other form of tech ETF. But that's because tech as a sector has been doing well over the last 5 years. It's a cyclical growth story in the tech sector because of various things that's happened, and that is going to continue in some form or the other. So the key thing is to look at trends, what's happening in the economy, which asset classes are going to increase, which sectors are going to, and then just plow in and then do the investing which suits you best. If you have the capacity to follow a few stocks, do single stock. If you don't have the capacity or don't have the interest, then you can just buy the ETF in that sector and just get the exposure.
Are there any specific themes that you could think, let's say in the next 10-year kind of scenario? Broadly, you touched about China, how positive you're on China, but are there any themes that, let's say, investors could benefit?
I think I'm still very bullish on the US tech sector. So when I look at things like telemedicine, Teladoc, I think that will do well. If I look at what's happening in the cloud software, i.e. companies that are offering computing capacity, data capacity to businesses, they will do well. Those are multi-year growth story because everyone would want to use them. I'm looking at restaurants now here, trying to do UK-wide distribution, which would have never happened. So forget about delivery part. Even to create that, you need a website, you need data, you need things to work around. These guys are not IT expert or tech expert. They're not going to employ 100 people to build the system. They're just going to buy off the shelf a Shopify or Etsy or somewhere tool, which is just going to make them money. Then they need data, then they need the cloud storage. So I think that all of these sectors which are going to support businesses in the change behavior that we are going to see, they're all going to make money. Now, of course, some of these stocks have risen 500%, 600%, so you might have a big correction. But looking at a 5-year cycle, I'm a strong believer that these stocks are going to make money and that sector will continue to do well.
I think you're closer in Europe. I think a lot of ESG investing is done and India is still nascent. So if you were to take lessons from Europe, what could one take on ESG front? Or do we look at ESG as just another portfolio and not be too much bothered about specifically investing in such portfolios?
So I would say that ESG is a very broad topic. Do I believe that ESG is here to stay? Yes, in some form or the other, because when Wall Street makes up its mind that something is going to happen and money is thrown at it, things do happen. So I think people have made up their mind that they need to cut carbon emission, they need to use electric vehicle, they need to use hydrogen, and those are longer theme. Money is being pushed onto that research, and if you come out and say, oh, here's a hydrogen truck, and I'm not mentioning Nikola at this point because they don't seem to have a truck, but if somebody else comes up with research which provides them that they're going to create things which are less energy consuming, less pollutant, of course it will be endorsed. So ESG as a theme is going to stay. Who is going to win that, we don't know. Some of the people are now shopping around showing ESG baskets. Same companies just tweaking their method. I don't think that's going to sustain, though they will continue to do that. I don't believe in tick boxing. Tick boxing is going to work, but I'm an ardent believer that you will have good companies and good business coming out who will deal with reduction of carbon, who will deal with use of hydrogen more as an energy source, and any other form which is acceptable to the people. That is not going to change because even if you look at the acceptance of the people and the demographics that we are talking about, who are very passionate about some of these issues, they're just not going to go away. It is just going to be part of, so it has to be taken seriously. And whether you believe in climate change or not, and whether you believe that how long this effect can happen, But once a population has made up its mind, they're going to implement. So purely thinking from investor point of view, yes, you will be doing well off if you take these topics seriously and some of the companies that are going to come out of it.
One last question, Manish. Are there any bubbles that one should be aware of? And specifically, is sovereign debt a bubble which one should be really careful about?
I think it is a bubble, but then, it is backed by printed money. So, US is not going to bankrupt because they'll just print and give you the dollar that you desire. So that how long can it be sustained? It's a moot point at this time. If you have the power to print your own currency, which US has, if you have the military strength to enforce contract, which US has, then dollar will be fine. What you really need is the military might to enforce your contract. And dollar is being used as a basis of world currency, which is probably going to stay, though China is going to come at it, and China is coming at it. But then, in my opinion, China is a bit like Apple, and US is like Microsoft. So Apple never took Microsoft on its own patch. Apple went and developed its own operating system, developed its own market, and that's what China is doing. So China will engage with the local economies. When you have a Chinese government bond that yields you 3%, and you have a US bond that yields you 1% or 0.5%, or European one 0%, it's a very easy argument for China to make. Okay, 10-year bond, I'm going to give you extra 29% return. What is your probability of China currency falling by 29% over the next 10 years? Very small. It's never happened. So you start making an argument to a central banker sitting in some neighboring country in Asia, and they say, well, and you're going to trade with us, and I'm going to settle these trades in renminbi. That's how you create this parallel system, which China is doing, and they will continue to do. But it will not be so soon that it is going to destabilize the dollar. But China has got nothing to do to destabilize the dollar. Our dollar will destabilize itself if there's a parallel system that is being built up, and if US continues to be profligate in printing money and using only those means to manage their economy. So in these things are multi-decade things we are talking about, so it is difficult to say whether it's a bubble or not. The key question one should look at is there growth or not. On that basis, I find Eurozone far more precarious, that they do not have growth. And you also have Eurozone where sovereign nations have come together of varying capacity of economy in a fixed exchange rate system. That just cannot work. It's just going to make people poorer and the growth worse. So if there's one place I'm concerned about, it's Eurozone. There I wouldn't be buying government bonds. There I would be buying private companies, because private companies are going to sustain whatever happens to euro, because they are selling to the whole world. I'm a big believer in private businesses and private assets, which have a client base, which have things to sustain. They don't go bankrupt because the clients are there, they will buy. But a government could go bankrupt because they don't have means to pay, because the economy is not doing very well. So be very careful about sovereign bonds you buy. Buy it in economies where they have the history of managing budget properly, or at least they have the intention of doing it and the ability. Other than that, invest in private companies, private listed companies with global assets. And there are plenty of them to choose from, and they will hold you in good stead because you will be in safe hands.
Great message to end with, Manish. Thank you very much for your time.
Thank you. My pleasure.
Various things.
Thank you. Bye-bye.